Good morning and welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at MarketSite, we have Michael Venuto. He's the chairman of the TETF Index, and we're going to focus on M&A trends within the ETF space. Mike, it's great to have you back with me at MarketSite. A year goes by really quick, doesn't it?
Good to see you, Jill.
All right, so before we get into M&A trends, why is it important to measure ETF growth overall in the industry?
Sure. So, we think of ETF as a structure. In fact, we think of it as the fintech version of the mutual fund. It's just a better wrapper. And we're watching as many companies that have historically been asset managers in the traditional ways moving this way. And the idea that you can participate in that growth, right? It's a trend that's been occurring for 25 years. That's 20% annualized growth. Participating in that seems like a pretty obvious thing to do.
What are some of the M&A trends that you're seeing within the industry right now? Because it seems as if it continues to occur, I mean, even just this week.
Yes, absolutely. So we look at it and say, why are they doing it, right? Because that's really how it's going to materialize in the growth. And, this year we saw some big ones, Invesco acquiring Guggenheim and then Oppenheimer funds. Those were really expanding a lineup. That's probably one of the more common things that we see, right? Is we need more product, let's just go acquire it. The second tranche we see is geographic distribution. So this year, Murray acquired Global X funds. Wisdom Tree went on a acquisition spree in Europe. So it's about having exposure to the ETF industry, but not just in the US or not just in Europe. And then finally, it's about expanding distribution, not geographically, but through technology or through people. So we've seen most ETF companies acquire some sort of robo-advisor. So the robos aren't doing terribly great on their own, but as a tool to grow ETFs, they've been spectacular.
It sounds like scalability really is the key word here. Do you continue this M&A? Do you think this M&A spree will continue? And how has the industry evolved, over the past 20, 25 years that they've been in existence?
So, people forget how quickly this all occurred, right? Like, the iShares acquisition was for nothing when you think about the grand scheme of how big iShares is now with inside BlackRock. It's now over 30% of their assets, right? They've gone from 10% of their assets, ETFs, when the acquisition occurred, to 30 and maintained margins. So this whole race to zero is great for investors, but it's not actually hurting the ETF issuers. They're finding new ways to make money. They're doing sec lending or various different things.
Yeah, I get the sense they're always going to find a way to make money.
Yes, they're not going to do it for free.
Right, exactly. So where do you see the ETF space in the next 5 to 10 years?
Sure. I think the 20% annualized growth will continue. Last year we were closer to 30. This year we're a little slower because the markets have been quite a bit more volatile. But we're annualizing at 20%. So you do those numbers, and we're going to be doubling every 5 to 6 years.
Right.
And even at that rate,
which growth rate are you reflecting?
The growth rate of the ETF assets.
Assets
themselves.
Right.
They've been annualizing about 20%.
And is that at the detriment to the mutual fund industry?
Not so
just
much.
Fresh money coming in?
Mutual funds have grown as well. That's one of those secrets that people don't realize. They're not taking in new money in the high fee equity portfolios, but mutual funds have grown. ETFs, however, are growing at 20%. Mutual funds are growing at 2 or 3.
Well, thank you so much for joining us at MarketSite. And thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.